Welcome. Today, we're making sense of public sector finance, specifically Ipsas 9. This standard guides governments on how to account for money they earn from exchange transactions. Why does it matter? Because it's about transparency and good governance. We'll break down Ipsas 9 into simple, real-world steps. No jargon, just clarity. By the end, you'll know when a government agency can say, "That's our money," and how to record it. We'll use practical examples, tuition fees, city permits, and advance payments. This is the foundation of accountability, ensuring public funds are managed and reported correctly. Understanding revenue recognition helps everyone see a clearer picture of government finances. Ready to demystify public sector accounting? Let's get started. It's going to be more interesting than you think. Let's define exchange transactions when a public entity gives and gets something of roughly equal value. Think buying a book at a museum shop or paying for a driver's license renewal, money for a direct service or good. The opposite? Non-exchange transactions, like taxes or fines, where you pay but don't get a direct equal return. Why does this matter? Because Ipsas 9 only covers exchange transactions, where there's a clear this for that. Examples: hospital pharmacy sales, pool fees, university tuition, or renting a government building. For exchange transactions, revenue is recognized when the goods or services are delivered. For non-exchange, it's when the government has control of the cash or an enforceable claim. This distinction ensures financial statements show how resources are generated by trade or by authority. Get this right, and you're halfway to understanding public sector revenue. It's all about matching the right rule to the right transaction. Let's see how the rules work in practice. So, when can you record revenue? Ipsas 9 says 4 conditions must be met. First, risks and rewards of ownership have transferred to the buyer, like when a government sells a car and the buyer drives away. Second, the seller no longer controls or manages the goods sold. Third, the revenue amount can be measured reliably, usually the invoice price. Fourth, it's probable the entity will actually get paid. All 4 must be true before revenue is recognized. For services, it's about when the service is performed and the customer is billed. These rules prevent revenue from being recorded too early or too late. They ensure financial statements reflect reality, not wishful thinking. Miss a step, and you risk misstating your finances. Let's see these rules in action with journal entries. Let's get practical with journal entries. Example 1. A public works department sells gravel for $5,000, paid in cash. All 4 conditions are met. The entry debit cash $5,000, credit sales revenue $5,000. Example 2. A city issues a building permit for $10,000, service complete, but payment due in 30 days. The entry debit accounts receivable $10,000, credit service revenue $10,000. When the developer pays, debit cash $10,000, credit accounts, receivable $10,000. These entries tell the story of money earned and received. The key revenue is recognized when earned, not just when cash arrives. This approach keeps financial statements accurate and transparent. Whether it's cash or credit, the rules stay the same. Next, let's tackle what happens when money comes in before the service is delivered. Advance payments are common and need special handling. Here's how Ipsas 9 deals with unearned revenue. Sometimes public entities get paid before earning the money, like a university collecting tuition before classes start. On payment day, the university hasn't earned the revenue yet. Instead, it records a liability debit cash, credit unearned revenue. Unearned revenue signals an obligation to deliver a service in the future. As classes are taught, the university gradually moves amounts from unearned revenue to tuition revenue. This prevents overstating income and keeps reporting honest. The money isn't truly earned until the service is delivered. This process is crucial for transparency and accountability. Next, let's see how to recognize revenue over time as services are provided. It's all about matching revenue to the period it's earned. Suppose tuition covers a 4-month semester. The university can't recognize all the revenue at once. It must spread it out. Each month, 1/4 of the tuition is recognized as revenue. The entry debit unearned revenue, credit tuition revenue for that month's share. Repeat this each month until the service is fully delivered. This method matches revenue to the period the service is provided. It gives a true picture of monthly performance. After the last month, unearned revenue is zero, and tuition revenue reflects the full amount earned. This is the heart of accrual accounting. It ensures financial statements are accurate and fair. Let's recap. Ipsas 9 covers revenue from exchange transactions, fair trades of goods or services for value. The 4 recognition rules ensure revenue is only recorded when truly earned. Advance payments become liabilities, unearned revenue, until the service is delivered. As services are provided, revenue is recognized over time, not all at once. This approach matches income to the right period and prevents overstatement. Whether it's a cash sale, a service on credit, or an advance payment, the principles stay the same. Consistent application builds trust and transparency in public sector finances. Mastering these basics means better, more reliable financial statements. It's about telling the true story of public money, and that's something everyone should care about. That's our whirlwind tour of Ipsas 9. We've covered the essentials, fair trades, the 4 rules, and how to handle advance payments. If you have questions or want a handy Ipsas 9 cheat sheet, drop a comment below. Practice problems and extra resources are available to help you master these concepts. Remember, understanding these rules isn't just for accountants, it's for anyone who values transparent government. Keep asking questions and exploring. Thanks for joining me. See you next time for another deep dive. Until then, let me know what's on your mind.